Hello, good afternoon, everybody, and welcome to this month's Ask InCorp webinar. Uh, Welcome everyone who is joining this webinar this afternoon. We have some interesting compliance updates that we want to share with you all. Let's give it a few more minutes, and then we can start the webinar session. Okay, we'll start the webinar in about 2 minutes. Okay, I think we can get started. Good afternoon again, everybody, and welcome to this month's Ask InCorp webinar. Happy to have all of you joining us for this month's session. Today we'll do some compliance update, specifically 2026 compliant review. There were some key regulatory updates affecting FDI investment in Vietnam. And this afternoon, we'll highlight three key changes that are affecting FDI operations in Vietnam. Next slide, please. Okay, quick introduction about myself. My name is Jack Nguyen. I'm the CEO of InCorp Vietnam, an Ascentium company. We are currently called InCorp Vietnam, but in the next 2-3 months, we'll gradually be rebranding to Ascentium Company as a FYI note to everybody. I've been working in Vietnam for over 14 years now. I have over 25 years of professional experience, and I am a trained CPA from Canada and Vietnam, and I've had a leadership role in a few companies in the past 10 years in Vietnam. Next slide, please. And I'll let Ms. Cecilia introduce herself.
Hi, everyone. My name is Cecilia Nguyen, and I am the Senior Legal Compliance Manager at InCorp, an Ascentium company. I already have nearly 15-year working experience to support the foreign investor and enterprise in Vietnam, and specialize in the foreign investment as well as for the business sub-license registration and for the expatriate service, with the strong focus on the practical and compliant markets and operation. And a part of my expertise, I focus on drafting and review the service agreement, including for the FedEx contract. And I also a member of Ho Chi Minh City Bar Association for more than 10 years and practice in the law field. Thank you, and Jack. Next slide.
Yeah, thank you, Cecilia. Just want to give everyone a brief background about Ascentium, the brand that we will be moving to in the next couple of months. Ascentium has acquired a group of companies over the past couple of years, and in that includes InCorp, Harney's Fiduciary, which does mainly trust services. Virtual Zone is a corporate service firm based out of the Middle East, and Links is a global payroll firm. We are all under the same company, and we're also be rebranding to Ascentium in the next few months. Next slide, please. Right. Um, Ascentium is actually a pretty young company. We're only 2 years old, or just over 2 years old, but we've now expanded into across Asia Pacific, and we have presence in the Asia continent, the Middle East, Europe, and the Americas. So we are serving in 25 countries around the world with 50 plus offices, and we have close to 3,000 strong professionals serving our clients worldwide. Next slide, please. Quick introduction about Ascentium or InCorp Services. So we have 7 pillars of services that we deliver. Legal and corporate services for market entry foreign companies coming into Vietnam. We also provide compliance service for HR and payroll, accounting and tax. We also do market intelligence for companies that are looking for business research before entering Vietnam. And we also do recruitment, staffing, and IT and ERP services. Next slide, please. Okay, the agenda for today, as I mentioned, we'll cover 3 new regulatory updates. I will cover Circular 20. Cecilia will cover Decree 96 and Decree 103. And then after that, we'll have a quick Q&A session for anyone who may have questions. Next slide, please. So for Circular 20, we'll talk about detailed guidance on corporate income tax. Circular 20 actually took effect on 12th of March 2026, this last month, and it fundamentally shifts the burden of proof to the taxpayer. Under the old rule, a general invoice was often enough to claim a deduction. Usually we call VAT invoice or red invoice. But now there are over 25 expense categories, each with its own specific documentation requirements. And if you miss any single document, then the entire deduction may be disallowed. So it's very important that you know the categories and the documents that you need to get to claim deduction. The non-cash payment threshold has dropped from 20 million Vietnam dong to 5 million Vietnam. So that's quite a bit of a drop to 5 million Vietnam dong, meaning any transaction above the 5 million without any bank transfer or check automatically loses deductibility. So you have to have documentation to show what the transfer is for to qualify for deduction. And also revenue recognition is no longer based on when you get paid. Instead, it depends on the activity. So revenue recognition, if you will think in the past, it's always been on a cash basis. When you get paid, that's when you recognize revenue. But now it's based on activity. For example, for construction, you recognize revenue when the work is accepted, not when the client pays. So that means is that you will probably have to recognize revenue earlier in the process, not wait until when work is accepted, when you get paid by the client, which can create quarterly tax liabilities earlier before cash arrives. For foreign investors selling their stake in Vietnam, the tax on capital transfer has changed from 20% on net profit to 2% on total selling price. That's a big change, right? And we'll go into more detail, but before it was on net profit, but now it's on the selling price, even if you have a loss. you still have to pay tax. Okay, so it's based on selling price. So you have to pay regardless of whether you profit or break even or lose money on the transaction. You can also choose transitional application dates, either 1st of October or 15 December 2025, whichever benefits you more. So don't ignore that election. Next slide, please. All right, capital transfer tax. This is the biggest change for foreign direct investments in Vietnam. Um, Let me give you a concrete example to show why this capital transfer change matters so much. Okay, if you sell a Vietnamese company, for example, for 100 billion dong and made 30 billion dong profit, in the old way, you would only cost you 6 billion in tax, right? 20% of 30 billion is 6 billion in tax. But the new rule will only cost you 2 billion. So high profit exits, you pay less tax now. So where companies are exiting and they're very profitable, you pay less tax on an exit. However, if you sell at break even, um, under the old rule, you don't pay any tax on it. But the new rule, you will require to pay 2 billion tax on that. And if you sell at a loss of 10 billion, the old rule, again, zero tax on that. But now the new rule will cost you 2 billion. So that's a fundamental change in how the government charge tax on a capital transaction in Vietnam. And the premise behind that is that, if you've been profitable over the years, the government would have already got tax from you already. So they're okay with getting less tax on the transfer and exit. But if you've been having losses over the years, that means the government haven't collected any tax from you. But now they want to make sure they collect something from you before you exit. Hence, they charge you a fixed cost of 2 billion, 2% of the selling price. Okay, 2%. So that's a fundamental change in how government charge tax on a capital transfer. So the tax applies to both direct transfer of Vietnamese shares and indirect transfer. Selling a foreign parent company that owns the Vietnam entity, you cannot avoid by structuring offshore. So that option is no longer an option. It's no longer a tax planning option to avoid paying tax. There's an intra-group restructuring exemption that could give you zero tax, but the four conditions are broadly undefined, and no administrative procedures have been issued yet. So you probably need to get legal advice before assuming you qualify for the exemption. The tax trigger when the sales contract becomes effective, not when money changes hand. Again, this is a change, right? Before, when the tax is applied when money exchange hands, but now it's when the sales contract becomes effective. Okay, so the government wants to make sure they collect the money first. They're not waiting to the buyer and seller does the cash transaction. So practical steps: factor the 2% into every exit model. Document intra-group transfers carefully. Get professional advice for cross-border indirect transfer, and monitor for further guidance on fundamental conditions. Okay, so be aware this is a fundamental change in how government tax share transfer transaction. Slide 12, please. Next slide, please. Okay, deductible expenses. There's stricter documentation requirements. Okay, so for everyday expenses, the old rule was simple: keep an invoice, red invoice, and the expense is deductible. The new rules, an invoice plus category-specific documents, and if any document is missing, the deduction is gone. You do not qualify for deduction anymore. Okay, so this is very clear, specific rule, new rule to deductibility. So for example, sponsoring a school for 100 million Vietnam dong used to require only a receipt. Now you need to sign a Form 01 TNDN from the school. No form, no deduction. Okay. Another example, training expense require graduate certificates or diplomas, not just enrollment record. Okay, you have to prove that you actually attended the training event. and that you have the certificate or diploma to show for it to qualify for a deduction. Unsuccessful bids and failed R&D are now explicitly deductible, but you must keep bidding documents, research reports, and proof of spending. Okay, so again, while the government allows for deduction for R&D, you have to keep clear documentation to qualify for deduction. Green transitions expenses are a brand new category. Keep clear records and of everything green related. Okay, and remember the 5 million VND non-cash payment rule. Any transaction above the amount paid in cash is automatically disallowed. So please overhaul your expense tracking system, train your finance team, and create separate folders for each category. Okay, so any amount paid above 5 million, you can have electronic records and receipts. Okay, or else it's automatically disallowed. Please be aware of that. Next slide, please. Right. Revenue recognition timing and foreign contractor tax. The timing of revenue recognition is a common trap. Many people think you record revenue when the customer pays, but the new law says you record when ownership transfers, work is accepted, or the contract becomes effective. So that's earlier in the process. The government requires you to recognize revenue. So it's even earlier and not wait until you get your payment. Construction is the biggest trap. You finish a project, for example, you finish a project in December 2025, but the client pays you in March 2026, 3 months after. You still owe, under the new law, you still owe quarterly tax in December 2025, the months before the cash arrives. So beware of this new change. Okay. So for exports, revenue is recorded when ownership transfer, which depends on your terms. Make sure your contracts specify the transfer point clearly. For capital transfer, revenue is recorded when the sales contract becomes effective under Civil Code Article 401. For electricity or water, it's when consumption is recorded on the invoice. For securities, it's a date of transfer. On foreign contractor tax, Circular 20 now explicitly includes digital platform operators. If you run a foreign platform with Vietnamese user, like live streaming, e-commerce, or social media, you may have withholding tax obligations in Vietnam. So practical steps: align your construction tax planning with acceptance dates, not payment schedules. Specify Incoterms in every export contract. Structure capital transfer effective dates carefully. And if you operate a digital platform with Vietnam revenue, review your following obligations and make sure you have withholding tax. Next slide, please. Okay, so I'll pass the next decree, a new decree, to Ms. Cecilia, and I'll be back for the Q&A session. Thank you, everyone.
Thank you, Jack. So for the next part, I will walk you through on the new decree for 96. So this decree implement the new law on the investment, and this one will shift the Vietnam from the pre-approval to the post inspection. And under the old rules, the government vet everything before you started. That took time, but once you had the approval, you were fairly safe. But under the new rules, the approval are faster, just 15 days, for the green channel projects. But the government will check you for your operation, and if you find a problem, the penalty can include it for the suspension or the termination of your projects. The entry sequence used to be mandatory for the RC first and then ERC. Now, the new regulation is allow you to set up the company in Vietnam first, so means the ERC first. And then the IRC will come later within 12 months. But we will see on next slide, this is not yet workable in practice for now. And the capital requirement have changed. The paper capital is no longer enough. Only the actual capital injection qualifies for the incentive. know all loophole of the registering high capital on the paper to get land on the tax breaks is now closed. And for the practical stuff, so understand that this is not a reduction, but a relocation of the enforcement effort. Use the real capital, not the paper. Budget for the legal counsel early because the mistakes are more costly now. And build 3 to 6 months of the buffer into your project's timeline for the immigration gap. Next slide, please. Okay, so I mentioned in the first slide, this slide is very critical because it's 1 year about the gap between the law and the practice. The new law says that you can get the company set up first in Vietnam, then the investment registration certificate will come within the period of maximum 12 months. But in fact, the current enterprise registration firm under the Circular 68 do not yet include the required market access commitment language. And the Business Registration Authority have not received the detailed instruction for handling this case. So I think that the Circular 68 will be amended soon to adapt with the new regulation of the Decree 1996. So therefore, in practice, the foreign investors still need to follow the traditional flow to obtain the RSC first and then ERC. And the 12-month golden windows legally permit you, but not yet workable for now. Please keep an eye on that. And for the new investment project or the set up the new company in Vietnam, what should you do for now? Still follow the traditional one, the RSC first, and then to set up the company later and monitor for the amendments of the Circular 68. So do not assume that 12-month window is ready for now from as today, and consult with the local authority in your target province before you attempting anything new because the implementation can vary from one province to another province. Next slide, please. And now I want to show you this very important update for the compliance report related to the foreign investment projects in Vietnam and see how different to compare with the old regulation. And you will see that before this decree, the old regulation, you just have two separate categories for the compliance report related to the foreign investment projects in Vietnam, including for the FDI and ISA. So under the old rules, the FDI report only requires your company to submit 5 reports per year, and that number has not changed. For now, your company still have to submit 5 FDI reports annually, but very important update related to the ISA report. The one is focused on the investment monitoring and evaluation have increased dramatically. Before the Decree 96, you only fill 2 ISA reports per year, but for now, it's increased to 6. Means that you need to submit the ISA report quarterly and plus for the semi-annually and the annually report. So that adds to 6 reports every single year. And to compare with the old resume, you are now filling 4 additional ISIS reports annually. And this is triple the currencies. So for this, I would like to bring you the attention for the first slide of the quarterly ISS report of 2026. And the first deadline is by 10th of April, which is already passed. And as you may aware, all of these reports are now submitted online through the online system of the government. So I think that for the next thing, your company should focus and update first your compliance calendar immediately to add 4 more quarterly report of the ISA to the calendar. Secondly, you must have a separate person on the team to manage the FDI and ISA report to because they pull down data from the different sources and go to different authority. And thirdly, set up the automatically reminder for each of the deadline so to not miss any quarterly report. And this is will notice you a penalty or the administrative penalty for the late submission. And just for this slide, I just would like to highlight for the first deadline of the analysis report by 10th of April. I think that after this webinar, if your company have not updated for this, you should update this and submit the first IDSIS report of this year as soon as possible. Next slide, please. And this one's for the green channel and the investment incentive. For the projects located in the industrial park, the export processing zone, the EBZ, the high-tech park or the free trade zone or the international financial center, your projects in Vietnam may qualify for the green channel with the processing time of only 15 working days. However, there are a trade-off. You must commit in written to comply with all technical standards. And if you fail to meet those commitments after operation, the government can suspend or even terminate your projects in Vietnam. So speed comes with the serious accountability. So the new incentive framework eliminates the old loophole where the company registers the large capital on the paper to get the land or the tax break, but never actual send the money. Now only the actual capital injection qualify for the incentive. The reality sector newly included for the AI, the semiconductor, data center, pharmaceutical, innovation, digital transformation, and the dual use technology. For the practical stuff, if your project is in the industrial park or the EBZ, evaluate the green channel eligibility, but understand the post-compliance risk before opting in. Create a clear capital contribution roadmap with a real disbursement milestone for the AI, semiconductor, or the data projects. Prepare to document your eligibility, maintain the record of every capital injection, and notify the authority at least 30 days before the construction begins. Next slide, please. And to be careful with the retraction risk and the action plan. So the common retraction risk, including for mismatching your industry description with expanded restriction market access lists, insufficient financial capacity documentation, failing to meet the disbursement threshold, submitting an incomplete environment impact assessment. So your company in Vietnam now needs a full EIA, not a preliminary one, and missing 12-month deadline if you attempt to set up the company in Vietnam for the ERC first. However, these are very positive protection under the Article 12 of the investment law. If the new regulation changes investment incentive, the investor are guaranteed continued application of the incentive documented in their RRC and the investment license. And that means once your incentives are locked in written, you stay locked even the law changes later. So make sure every incentive you are entitled to is clearly written into your certificate. And the practical step, do a legal audit and the restricted list before submitting anything. Prepare the full financial evidence and a complete EIA and document your capital disbursement carefully and engage a legal counsel early because the mistakes are more expensive under the post-inspection regime. Next slide, please. Okay, so move to the next. I will give you some new key update under the decree 103. This is will guide for the outward investment from Vietnam. Okay, what is the decree 130? As mentioned in the previous slide, this is the one decree for guidance on the outward investment from Vietnam. And now I will give you a big picture for this decree. So this decree is shift the offshore investment management from a uniform pre-approved to the risk-based digital driven that fundamentally changed how Vietnam investors plan and execute the overseas expansion. Look at the comparison table. The lead agency had changed from the Ministry of Planning and Investment to the Ministry of Finance. So now you're dealing with a completely different authority, and the certificate requirement is no longer universal. For the projects under 7 billion Vietnam dong and not in the conditional sector like banking or real estate are completely exempt. You only need to register the foreign exchange with the bank. So approval tiers are now very clear. For the projects from 7 billion Vietnam dong, the MOF will issue the certificate. For the projects more than 25 billion Vietnam dong, the MOF must get a written opinion from the SPV, the State Bank in Vietnam, in which is the processing time will add more 7 working days. And for the projects at 1,600 billion Vietnam dong, or for the projects with specific support policy, the Prime Minister must approve first. And for the profit repatriation has improved significantly. You now have 12 months from the actual distribution day, not 6 months from the tax filing as before. And the submission is now 100% digital, no more paperwork. And if you have a plan to have a project outside of Vietnam for now, what should you repair? Firstly, you should check about your total amount of the investment amount. So for to check the qualify for the 7 billion Vietnam dong inception, it will save time a lot. But you still need to do the foreign transaction registration with the State Bank in Vietnam. And secondly, if your project is 25 billion Vietnam dong or above, bill in an extra 7 days for the State Bank consultation and respond with the written. So thirdly, for the projects of 1,600 billion Vietnam dong or above, prepare for the Prime Minister approval. That is higher level. And the fourth, track the profit repatriation from the actual day you receive the profit, not from when the tax are filed. And the fifth, go digital, register for the National Investment Information System because the paper submission are now no longer accepted. Next slide, please. And I will go more detail about the exemption from the obtaining the offshore investment registration certificate I mentioned at the previous slide. So for the first mature change under the Decree 103 is that not every offshore investment project needs a certificate anymore. Under the old Decree 31, every single project, no matter how small, require a full offshore investment registration certificates. That means that weeks of the paperwork and waiting for the Decree 103 introduced 4 categories of the projects that are completely exempt from this certificate requirement. And for this one, I would like to add one more thing for your information. For all of the offshore investment certificate with the capital injection below 7 billion Vietnam dong, if the investor would like to amend any information on the rented offshore IRC, it is not required to go through the process of amending the offshore IRC anymore. It will exempt to as the same for exemption of obtaining the offshore IRC for the projects under 7 billion Vietnam dong. And the most common category is small project. If your offshore investment capital is less than 7 billion Vietnam dong, it's with about 280,000 US dollar, and your project is not in the conditional sector like banking, insurance, security, real estate, or the media, then you are not required to get the offshore IRC at all, as the old rules. You only need to register your foreign exchange transaction with the state bank before the investor sending out the money to the foreign country. So there is also an exemption for large established enterprise that met four conditions. They must be classified as the large enterprise, use their own foreign currency, no loan, be reflectable for 2 year consecutive years, and have at least two prior offshore projects that successfully repatriate profit. So the key practical point is that even the exemption, you must still complete the bank registration. Missing that step means your capital transfer could be blocked. And so if you are qualified, self yourself the certificate process, but do not skip the foreign exchange registration with your bank. Next slide, please. And I mentioned in the first slide for the update of the decree 103. So the new approval tier are now very clear for the scale of the projects. For the projects under 7 billion Vietnam dong is exempt from the upside IC. For the projects with the capital more than 7 billion Vietnam dong, which is approved by the MOF, and for those projects with the capital as more than 25 billion Vietnam dong, the MOF will grant the IRC upside but must get the written approval from the SPV. And for the projects more than 1,600 billion Vietnam dong, the Prime Minister will approve for this. Next slide, please. So for this one, using the foreign entity expand to the third country, I will walk you through one of the most practical and long-awaited revision in the Decree 103. And I want to give you a concrete example so it's now clear. Suppose a Vietnamese company set up in a holding company in Singapore, and that Singapore entity then want to invest in projects in Indonesia. Under the old regime, there was no clear legal basis for that onward investment. Many investors operated in a gray area, risky penalty if the Vietnam authority discover the unregistered expansion. But under the new decree 103, changed this completely. Using the same example, the Vietnam company to the Singapore Hong Kong and to the Indonesia projects. The law now explicitly permit this, as long as the investor comply with the Indonesian law and report to the Vietnam Ministry of Finance. The table shows you before and after. So before, the Indonesia projects are legally ambiguous. After that, it is illicitly permitted. A clear legal basis onward expansion beyond the original scope of the registration used to require a new offshore IRC for each new destination with no guidance. Now it is permitted, but you must report to the Vietnam authority. Please be aware of this. And what is the reporting obligation? The Vietnam investment must the Vietnam investor must report the onward investment to the Ministry of Finance and the specific firm and timeline are still being guided. So stay updated. But you cannot expand suddenly. Why does this matter? Using our example again, a Vietnam investor with the Singapore Hong Kong can now lawfully invest in the Indonesia without needing a separate Vietnam certificate for that Indonesian expansion. That saves significant time and cost. But you must keep the Vietnam authority informed. So establish a clear internally process to report on work investment. Keep carefully record and work with the local advisor to stay updated on the reporting firm and the deadline. Next slide, please. So that's a key update for the decree 103. And for the next section will be the Q&A. So this is the one of the question that the webinar team already received before the webinar today. So question number one, if an enterprise is granted import duty incentive on the machinery, zero rate, will it be required to repay or retrospectively tax on that incentive when the machinery has been fully disrisitic and is later disposed or scrapped? Under what condition or what point is the enterprise allowed to liquidate or dispose of such machinery? For this question, I am pleased to invite Mr. Check to answer this question.
Yeah, thank you, Cecilia, and hi everyone. This is a very technical question, so I'll try to address this as best as I can. Um, so in Vietnam, import duty incentives on machinery are generally granted under the condition that the assets serve a specific investment project. So for it to be called a fixed asset. When these assets are no longer used for that project, okay, even if they are fully depreciated or sold as scrap, the purpose of use has changed, triggering a tax obligation. Okay, so the asset no longer serves the purpose of use. So it's a tax trigger event. The first is requirement to repay or pay retrospective tax. Uh, an enterprise is generally required to pay import duty when disposing of machinery that was originally exempt. Under Decree 134 in the customs law, tax exemption is tied to intended use. So if you sell, liquidate, or scrap the machinery, you are changing that use. Again, my point. Uh, so you have to look at the valuation rule. You do not typically repay the full 100% of the original duty. Instead, you pay based on the remaining value of the machinery at the time of disposal. Secondly, is consideration for the scrap exception. If the machinery is truly non-functional or disposed of as scrap, the import duty is calculated based on the value and tax rate of the scrap itself, which by this up is probably very little value left, right? And much lower than what the original machine was imported at. And then you also have to consider the VAT implication. In addition to import duty, you must also declare and pay value-added tax on the domestic scale sale of the liquidated asset. So it's based on the value that's taxed on the import duty, and you have to pay VAT on top of that. So what are the conditions for liquidation or disposal? A company can liquidate machinery at any point, but to do so without penalties, you must follow specific regulatory procedures. And these conditions comprise of end of depreciation, technological obsolescence, project termination, etc. So I'll stop there. So I'll give you a brief answer already. If you want a more detailed answer, please get in touch with us. Thank you, Cecilia.
Thank you, Anja. I saw that Mr. Nguyễn Trường Xuân. May you share your question with us? Hello, Mr. Xuân. Can you hear us? I think you're on mute. Can you unmute? I think there is a technical problem with Mr. Sung. So I think that you can send your question to our team, and then after the webinar, we will follow up and reply your question as soon as possible. So I think I would like to, on behalf of the InCorp team and Ascentium company, to say thank you for everyone joining the webinar today. And please keep in touch with us, and we will see you for the next topic of the webinar soon. Thank you, everyone, for joining the webinar today. Thank you, Anja. Bye.